Welcome back to Economic Outlook. Today I want to discuss an idea that has begun to gain traction in Washington, D.C., the concept of a value-added tax, or VAT, to raise money to bridge the gap between federal expenditures and tax revenues. Before I explain why a value-added tax is not a good idea for the federal government to implement, I want to explain a little bit about the history of value-added taxes, as well as the mechanics behind their implementation in other countries and how they might be implemented here. Then I will explain why I believe the value-added tax would not raise the necessary revenues to bridge government expenditures, and why I think that spending cuts are necessary before any new taxes like value-added taxes are considered. Before I give my opinion on the viability of a value-added tax, I would like to discuss the mechanics of how the tax is actually assessed and collected. Typically, people think of value-added taxes as a form of national sales tax, but this description is somewhat incomplete. Value-added taxes are collected at each stage in the life cycle of a product or service. The value-added tax is applied and collected each time there is a transaction, as you can see in this diagram. Transactions can be between suppliers, businesses, or the final consumer. Each party only pays tax on the amount of value he or she has added to the price of the product. The example that you see here shows how a series of transactions might occur. Let's assume that a country enforces a value-added tax of 10% on all goods and services. A supplier might sell a company like Apple the raw materials it needs to build a product like an iPod. The supplier of raw materials would collect, for example, $110 from Apple, the $100 sale price for the materials, plus $10 for the 10% value-added tax. The supplier would pay the government the $10 it collected for its part of the VAT. Apple would then manufacture an iPod and sell it to a retailer for $200. Apple would collect $200 for the sale price plus $20, 10% times 200. Apple would pay the government $10. Although Apple collected $20 of VAT, the original material supplier already paid $10, so Apple's obligation is only $10, $20 minus the $10 already paid to the government. This makes sense because Apple added $100 of value to the raw materials and has a tax obligation for 10% of this value. It's important to note that Apple's gross margin remains the same, $100, despite the tax payments. The retailer would then sell the iPod to consumers for $275. This would reflect a price of $250 and $25 of value-added tax, 10% times 250. When the iPod is sold, the retailer pays the government $5, 25 minus the $20 already paid. This makes sense because the retailer added $50 of value to the iPod. The retailer's gross margin again remains the same at $50 after the tax transference. As this example demonstrates, value-added taxes are convoluted and difficult to understand. At each step in the process, accurate records are necessary to calculate the proper amount of tax owed to the government. Assessment of the tax is also inherently bureaucratic. It's important to note that the tax revenues are similar to a national sales tax. In the previous example, the customer paid $275 for her iPod, 10% more than the original price of $250. However, the responsibility for the collection and remission of the tax is distributed to each member of the process rather than simply the end retailer. VAT taxes actually originated in Europe after World War II. Today, they're mostly associated with the European Union and its neighbor countries, but value-added taxes are also present in South America, Latin America, and even Canada and Mexico. VAT taxes have a wide range of values. In Japan, the VAT is set at 5%, and in other countries like Sweden, value-added taxes are at 25% or slightly above that. The larger members of the European Union, like France, Germany, and the United Kingdom, all have value-added taxes ranging from 17% to around 20%.